Hello, good day, everyone. This is Dr. Don Charles, and welcome to my course, Day Trading Stocks. So this is my third lecture. This lecture is about finding stocks to trade. So the outline for today's lecture will include finding stocks to trade, tools required to trade, and creating a watch list. So the first topic for this lecture is finding stocks to trade. Many people are interested in trading stocks. However, the first questions they may face when they enter the market are, what stocks should they trade? What stocks should they buy? And what stocks should they sell? Traders are going on a market with the objective of making a profit. Then the relevant question they should ask is, what stocks are profitable? I have an additional question for you. Should you trade stocks that you like? Traders are entering the stock market to trade stocks to make a profit. Traders can make a profit from changes in the price of stocks. This can occur if the price of the stock changes. Therefore, traders want the price of the stock to change. In other words, traders want volatility. I mentioned before that volatility is a tendency for the price of a stock to fluctuate. Traders want stock prices to fluctuate. If a stock price moves from $10 to $11, then declines to $10, then moves back to $11, a trader can make a profit from these small changes in the price of the stock. Since traders intend to profit from volatility, they should look for the most volatile stocks. They can start looking for the most active movers. So here I am on this site, Yahoo Finance. I want to show you how to find the most active movers. I go down, click most actives. These are the most active stocks. So we see NOK, that's the ticker for the stock, Nokia Corporation. The stock price went up by 4.72%. Then we have TLRY. The stock price went up by 14%. Then we have AAPL, Apple. Their stock price went up by less than 1%. It went up by 0.53%. Then we have PLTR. Their stock price went down. It went down by 1.69%. These are the most actives. You can also look the biggest gainers and the biggest losers. So these are the biggest gainers. We have NOKPF, Nork Airlines Public Company Limited. It had the biggest price gain. It had a 72% price gain. Then we have MD, Menax Inc. They had a 19.96% price gain. Then we have BILL, Billcom Holdings Inc. They had an 18% price gain. These are the largest gainers. If you want to see the largest losers, click largest losers. These are the largest losers. So we have LTCN, Grayscale Litecoin Trust. They lost 17%. We have TDC. TDC is the ticker, Teradata Corporation. They lost 16.33%. So these are the largest losers. The next thing we want to consider when trading stocks is the relative volume. The relative volume is an indicator that shows how a stock trading volume is performing relative to its past trading volume. So if we see here a relative volume of 3.5, that means that the stock is trading 3.5 times higher than it normally trades. So what the relative volume does is looks at the current trading volume and compares the current trading volume to the past trading volume. So if the relative volume index, if the value is 3.5, this means that the volume of the stock that is trading now is 3.5 times higher than the volume of the stock that normally trades. As day traders, we want to see a relative volume of 2 or higher. In other words, we want to trade stocks where the volume is trading 2 times higher than what it normally trades. This means that there's some demand for the stock. If the relative volume of the stock is greater than the number 2, I want to emphasize the number 2. This means that it is trading more now than it normally trades. Now, once the relative volume is greater than number 1, it means that the stock is trading more now than what it normally trades. However, as day traders, we want to trade stocks with the relative volume that is greater than number 2. Why did I single out the number 2? Well, the reason why I single out the number 2 is that I want to emphasize that there's a strong demand. If the relative volume is greater than number 2, that means there's a strong demand for the stock. People are trading the stocks now more 2 times higher as they normally trade. So this suggests there's a high demand for the stock. So we want to trade stocks with a high relative volume. How do we see it? Well, let me show you. So we go to Finviz, and then we click a stock. I click a random stock, and I go to relative volume. This is the relative volume, REL volume. It is 3.75. This means that this stock is trading 3.7 times higher than it normally trades. This stock is YTEN. This stock is trading high on relative volume. So this stock, the price, it went up by 26%, and it is trading on high relative volume. This means there's a strong demand for this stock. And next thing we want to consider when trading stocks is the news. This might sound far-fetched to you, right? You may be familiar with the news, and the news may tell you about the things that are going on in your country. That is true. However, there's also news concerning the performance of stocks. The news that might be of interest to a company's stocks are the performance of the economy, the performance of the industry in which the company is operating in, or a report that indicates or reflects the profitability of the company. Don't worry, we will explore the news and the fundamental analysis in detail in a future video. Just note that the news can influence the price of stocks. Good news can cause the stock price to go up, and bad news can cause stock prices to go down. Tools required. So you saw me previously go to different websites to access information. If you're trading stocks, you need to go online on different websites and access their tools. These are the tools required. You are trading stocks, you need to look at stock charts. Stock charts show chart patterns. They show trends, they show uptrends, they show downtrends, they show reversals, they show continuations. They show when the market is going up, they show when the market is going down, they show when the market is going sideways. How do we see charts? Well, there are several websites that allow you to see these charts of stocks. Some of the websites are StockTwits, Trade Ideas, Yahoo Finance, and TradingView. Trade Ideas, you have to pay approximately $1,068 a year to see the charts. Yes, people with deep pockets can access Trade Ideas and they can pay for Trade Ideas services. However, I recommend that a trader considers Yahoo Finance. This is free. Yahoo Finance is free. I just showed how someone can access Yahoo Finance. Let me show you. So you go to this website address here, finance, finance.yahoo.com, finance.yahoo.com. and you can access Yahoo Finance. If you want to access FinViz, well, you could just Google search FinViz. FinViz. This is how you access FinViz. If you want to access TradingView, type in TradingView. Well, this is how you access TradingView. Usually when I go on TradingView, I already have an idea about the stocks I'm interested in. So I might just type in any random stock. So I typed in the search box here, the ticker for the stocks. I typed in IHT. That's the ticker for the stock. And the charts appear right here. This is free. I do not have to pay to see charts on TradingView. Apart from charts, stock traders also need to consider news. Well, I recommend that stock traders consider news. Some traders do not trade with news. Traders that trade based on fundamental analysis use the news to trade. I trade based on the news. I use fundamental analysis. Some traders do not use the news. Some traders do not rely on fundamental analysis. They rely only on technical analysis. Technical analysis involves charts, chart patterns, indices, indicators, and these different things about the price of the asset tell you if to buy or to sell an asset. That is technical analysis. I trade on technical analysis, but I also trade on fundamental analysis. Fundamental analysis is where we consider the demand and supply side factors that may influence the price of an asset. I trade based on technical analysis and fundamental analysis. Since I trade based on fundamental analysis, I recommend that any trader that is interested in trading stocks consider the news. If a stock trader wants to consider the news, they can look at Yahoo Finance, CNBC, or NASDAQ. Let me show you where you can find the news on Yahoo Finance. So this stock here is MD, Mednax Inc. This stock price is up by 19.96%. Why is the stock price going up? Well, I can look at the news. Scroll down. I'm seeing the news. Mednax Q1 earnings and revenue beat estimates. This means that its profitability, its earning and its profitability is higher than what was expected. I can click the article here and I can read the article. Well, I can go in detail and read the article, and the article will explain why Mednax stock prices are going up by more than expected. This gives me the news about this company's stock. You can also see news at CNBC or at NASDAQ. Another tool you require to trade stocks on financial markets is a broker. The broker I recommend is Capital Markets Elite Group. So I go here. I type in Capital Markets Elite Group. I click here. And this is the broker. You can log in. Well, if you have your login ID and a password, you can log in here. If you are not registered with the broker, click here. Here's where you start the process to register with this broker. This is the website. You can see the URL here. So the next topic we want to consider for this lecture is creating a watch list. So when you are trading stocks, you start by creating a watch list. A watch list is a list of the various stocks that you are considering to trade. In other words, before day trading starts, you should already have an idea about which stocks you are thinking about trading. So you create a watch list. First, look at the most active movers. Go to Yahoo Finance and look for the most active movers. You can see the most active gainers and the most active losers. The most active gainers are the stocks whose prices are going up, and the most active losers are the stocks whose prices are going down. These are the stocks whose prices are exhibiting the most volatility. Let me show you. So here we are on Yahoo Finance. These are the most active gainers. These are the most active losers. These are the largest gainers. These are the largest losers. Let's click the largest gainers. These are the largest gainers. We can see the largest gainers are NOK, PF, MD, BILL, TLRY. These are the most active gainers. These are the most active losers. So we see the most active losers are LTCN, TDC, SHAK. These are the tickers for the company. FROG, AL. AL is the ticker for Airless Corporation. IBP, Installed Building Products. IBP is the ticker for Installed Building Products. These are the tickers. These are the names of the company. This column here shows you the price change. This shows you the extent in which the price declined. This is the volume of the stocks actually traded. This is the market capitalization for the company. This is the market price, the active market price for the company's stock. The next thing you can do is you can add the most active movers to your watch list. So let me show you. This is how I add a stock to my watch list. I click the stock here, click the symbol here, box, add to portfolio, add to my watch list. Click here. Click here. Then I go to Yahoo Finance Home. Then I go to watch list. So after I add the companies, I go here. I go to my watch list. And I can see the stocks in my watch list. These are the stocks in my watch list. After adding stocks to your watch list, the next thing you can do is look at the volume traded on the stocks. You want to trade stocks with a high relative volume. In other words, you want to trade stocks with a relative volume greater than a number 2. Another thing you want to consider is the float. The float is the number of the stocks that is actually available to trade. Some of a company's stocks is not actually available for trading since they are owned by workers, management, etc. The stocks that are actually available for trading is called the float. You want to trade stocks with a low float. Why? If there's a low float, that means there's a low supply. In economics, if supply is low relative demand, this can cause price to be high. Let me show you. So in a diagram here, in this diagram, this axis, the vertical axis shows the price. The horizontal axis shows the quantity. This is a demand curve. This is a supply curve. This is the first supply curve. Now, in this supply curve, the equivalent price would be this price here, where the supply intersects the demand. This will be equilibrium price. This will be equilibrium quantity. Now, if all a company's stock was available for trading, this would be the supply. However, some of the company's stock are not available for trading. This will result in a reduction of supply. This will cause a backward shift in the supply curve. So when a company has a low float, a lot of stocks are not available for trading. This results in a reduction in supply. It will result in a supply curve more analogous to this supply curve here, supply curve 2. This will cause prices to be higher. Why prices will be higher? Because it will intersect the demand curve. This is the demand curve here. It will intersect the demand curve at a higher point, resulting in this equilibrium price, and this will be equilibrium quantity. This is the quantity. This is the actual amount that is available for trade. This is the low float. If all the stocks were available for trading, this would be the quantity here. This would be the supply curve, and this would be the quantity here, Q1. However, when companies have a low float, less amounts of the stock are available for trading. This results in a low quantity for trading. So the quantity will be here, Q2, and generally it will result in a higher price. The higher price can result in P2 here. You want to trade stocks with a low float. If there's a low float, that means there's a low supply. If supply is low relative to demand, this can cause price to be high. It can also cause price to be inelastic. If the supply is inelastic, the supply curve will be somewhat steeper or more vertical. Generally speaking, this means that small changes in demand will cause large changes in price. In other words, a very small change in demand for the stock can cause a big movement in the price of the stock. That's why we want a low float. We want stocks with a low float because if stocks have a low float, if there's a small change in demand for the stocks, there can be a large change in the price of the stock. Since traders are interested in volatility and since traders are interested in trading stocks to make a profit from changes in the price of the stock, then if stocks have a low float, then if there are small changes in the demand for a stock, there can be a large change in the price of the stock. That's why we want to trade stocks with a low float. Creating a watch list. Every day that you intend to trade, you want to have about 4 to 5 stocks on your watch list. The reason why I mentioned 4 to 5 is because you don't want to overtrade. 4 to 5 stocks daily can help you achieve your daily target profit. If you trade too much stocks in one day, you can lose some of the winnings you made earlier in the day. The 4 to 5 stocks on your watch list should be the most active movers and the stocks that are trading high on volume. The relative volume on these stocks should be greater than the number 2. Also, there should be a low float. A low float will result in a low supply. A low float will also cause the supply to be inelastic. Inelastic means small changes in demand will cause larger changes in the price. Then the next thing you want to do is a bit of market research. You need to read the news concerning the various stocks and determine why the stock prices are moving. How do we find the news? Recall, you can go to Yahoo Finance. This is a company's stock, MD, this is their stock. I scroll along to the news. This is the news, this is all the news. And I can see here, this is recent news. I click here. Mednax Q1 earnings and revenues beat estimates. This means that the earnings and revenues, their profitability is better than expected. You can read the actual article here. I am not going in detail and read the article. I just saw some news that the company is profitable and the company profits is performing better than expected. And that explains why there was a 19% increase in the company's stock. So based on this news, this will make me put this stock on my watch list because 1, the company is among the most active movers. 2, the company is performing better than expected. While the third thing I want to consider is the volume, the relative volume. How do I find the relative volume? I go to FinViz, I type MD, I click the company, I go down to the relative volume, and I see the relative volume is 2.96. So since the relative volume is greater than the number 2, this tells me there's strong demand for this company's stock. So this stock already meet my 3 criteria. 1, there's a strong relative volume. 2, there's good news regarding the company in the sense that the company's profit is performing better than expected. And 3, the company's stock price is among the most active gainers. So this would make this company's stock go on my watch list. So you can see here, this is the chart regarding the company stock. Now we can see here, the company stock went up and the closing price was $32.10. So I see a strong movement in the price of the company stock. This will give me a signal to buy the company stock. Now, if I was actually trading this company stock, I wouldn't wait for the stock price to actually reach 32. When I see stock price open at $28.96, I see it went up to about $30.10, I would have started to buy the company stock because I realized that the company met my 3 criteria. 1, there was high relative volume. 2, the company was among the most active gainers. And 3, there was good news regarding the company. So it met my 3 criteria. The 4th criteria, or the criteria for entry, was a strong movement, the strong price movement in the direction with my analysis. And we see it happening right here. There was a strong price movement. Now, although I missed this move here, I would still enter a trade to go long on a company. So when the market opens, I would still enter a trade to go long on a company. So I would still buy this company stock at this price right here, $32.01. Trading based on a watch list. So the highest volume and the most volatility occurs when the market opens. So within the first hour when the market opens, there's the most price action and there's the most volatility. Traders should try to get in and get out the market within the first hour. So if the market opens at 9:30 a.m. in the morning, traders should try to buy the stocks, do the analysis before 9:30, do the analysis from the day before, and be prepared. So when the market opens, if they see strong price movement in the direction that they expect, they should enter order to buy or to sell the asset. And when they enter the order, if they were correct about the direction of the market, usually the trade will go in profit immediately and they can make their profit very easily. They could get in the market, make their target profit, and get out of the market very quickly. So within an hour or so, an hour to hour and a half, they can go in the market, make their profits, hit the target profits for the day, and then get off the market. Note that the most volatility tends to occur in the morning just after the market opens. In the middle of the day, from like 12, 1, 2, the market could still be volatile. However, there's reduced volume on the market. So the best time to trade is within the first hour when the market opens, when there's high volatility and there's high volume. Now, these are general rules. Avoid trading penny stocks. Penny stocks are stocks whose prices are less than $1. Avoid trading penny stocks because these stocks tend to trade on low volume. These stocks tend to be illiquid stocks. As a matter of fact, you should avoid stocks with low volume and you should avoid illiquid stocks. Why should you avoid these stocks? Because as traders, you want to be able to buy stocks and sell stocks whenever you want. You want to be able to get in and get out of trades. If you are buying and selling stocks with low volume, there's a possibility you could buy the stock. However, when you want to sell the stock, you will not be able to sell stock because the stocks are trading on low volume. So then you can be stuck with the stocks. That's funny. That's a pun. So as a rule, you should buy stocks with high volume. Note there's a distinction between the volume and the float. The float is the amount that is actually available for trade. So the float is when you take the total amount of shares outstanding and we deduct the amount of stocks that are not available, we are left with the amount of stocks that are actually available. This gives us the float. The float is the amount of stocks that are actually available for trading. The relative volume compares the amount of stocks that are trading today relative to the amount of stocks that are traded in the past. We want to trade stocks with a high relative volume. We want to trade stocks with a relative volume greater than a number 2. Why? Because if the relative volume is greater than a number 2, this suggests that the stocks are trading presently now 2 times higher than what they traded previously in the past. This suggests that there's a high demand for this company's stocks. We want to trade stocks with a high relative volume, and we want to trade stocks with a low float. So these are general rules. When trading stocks, get in the market, take a few winning trades, 4 to 5 trades, meet your daily target profit, and then get off the market. Do not overtrade. Overtraders take 10, 20, 30, 40 trades a day. Do not overtrade. If you overtrade, you will lose your money. You want to get in your market, make your profit, and then get off the market. If you overtrade, you will make some profits early in the morning. However, it's a possibility you could lose the profits you made early in the morning. Why? Because as the day progresses, the volume on the market decreases, and there may still be some volatility, but because the volume decreases, there's less opportunities for you to make some trade. And then there could also be scenarios where you want to enter trades, and then when you want to exit trades, you can't exit trades because the volume of the stock that is being traded has decreased. You want to get in the market early, make your profit early in the morning, get off the market within an hour or 2. This is how you want to trade stocks. You do not want to spend the whole day trading stocks. If you spend the whole day trading stocks, you can make your profits early in the morning, and then by midday, if you are greedy and you want to make more profits, you might find yourself making some trades, and the trades being losing trades. Now, 60% of the stocks that are traded on the market are traded based on high frequency. These are stocks that are traded by computers. Essentially, these stocks are traded by big corporations relying on computers. This means that there's a small volumes of stocks that are traded on high retail volume. Retail volume is the normal volume that we are expected to. Retail volume is when retail traders like ourselves do our fundamental analysis. We look at the demand and supply conditions, and then when we buy the stock based on these demand and supply conditions, these are the stocks that you want to trade. These are stocks that are moving because there's some reason driving their price action. There's some fundamental reason regarding the demand and supply why the stock prices are going up or the stock prices are going down. For example, the FDA, the Food and Drug Administration, may give approval for a new vaccine. This is good news for the stock of a company. So when the retail traders see this news, they might want to buy this company's stock. This can cause the price of the relevant company's stock to increase. Of course, it will be a drugs company that will be affected by this kind of news. Pre-market scanning. So in a day I intend to trade stocks, I start with pre-market scanning. I look at the most actives from the previous day. So I create my watch list and I look at the most actives for the previous day. Then I look at the relative volume. I put stocks whose relative volume is greater than a number 2. So if stocks are among the most actives, so they're among the most actives, meaning they're among the largest gainers or the largest losers, I consider them for my watch list. The second thing I consider is the relative volume. If the relative volume is high, if the relative volume is over or greater than number 2, I would consider these companies for my watch list. The third thing I consider is the news. I want to have a reason. I want to know why these companies' stock are moving in this particular direction. So I look at the news, I'll go to Yahoo Finance or I'll go to some other news source, and I will do my market research to determine why this company's stock is moving in a particular direction. After doing these things, the next thing I do is I look at the charts to see how much price action has already occurred. If I think too much price action has already occurred, meaning that if the price already went up too much, and I think if the price went up too high, I might not want to buy the stock anymore because I think that I miss out on the price action. In other words, the price already go up to where I think is the maximum, and I don't think the price will go up further, so I mightn't buy that stock. So I go on the chart, I look at the price action, and if I think there's still movement for the price to move in a particular direction, I'll buy the stock. If I don't think that there's much more movement, if I think that all the price movement has already occurred, I will not buy the stock. I will just monitor the stock and see what will happen in the future, or I will not buy the stock. In a general trading day, I tend to make 3 to 4 trades. Sometimes I make 5 trades. I usually make my profit within the first hour when the market opens. These trades tend to be good trades. Once I do my market research, I have a reason why the stocks should be moving in a particular direction. The stocks is among the most active movers. The stocks are trading high on volume. The stocks have a low float. These trades tend to be good trades. These trades tend to go into profit immediately. I get in and I get off the market quickly. I limit my exposure to the market. The longer you stay on the market, the more you expose yourself to the market, meaning that you might enter a trade, the trade might go in profit. However, if you leave the trade open for too long, some additional news might come out and it might cause the market to change direction, and the winning trade could end up turning into a losing trade. You do not want this to happen. You want to get in, make a profit, take a profit, and get off the market. As a day trader, this is what you want to do. You want to get in, make a profit, claim a profit, and get off the market. You do not want to leave your orders open for too long because the market can turn against you, and the open profits that you may have may turn into an open loss. So you want to go in, make your profits, take your profits, and then get off the market. By 11 o'clock a.m., I am usually off the market. Traders who are on the market at 1 p.m., 2 p.m., 3 p.m. tend to be traders that lost their money earlier. So these are traders that may have took some trades early in the morning, and they may have lose some trades, and then they're trading the market and they're trying to make back the money they lost earlier. However, they're trading at a disadvantage in the sense that there will be less trading volume later on a day than when the market opens. What traders need to do? Go in the market, make their profits early, and get off the market. If they made some loss, no problem, cut your losses, and then start a new day tomorrow with a fresh market, with fresh volatility and fresh volume, and try to make back the money that you lose previously. Yeah, you lose some money previous day, but traders need to implement a strategy and manage their risk. In managing their risk, there will be some trades that you might take a loss. However, these losses are part of your overall strategy. You will take some losses, but you will take some wins. Overall, if your wins are larger than your losses, you'll be profitable in the long run. So this brings me to the end of this lecture. Thank you for listening and stay tuned for more.